All right, today we're diving deep into a true giant of the hospitality world, Hilton. And we're going to be looking at it through an investor's lens, because it is a fascinating company with a really powerful capital-light business model that's proven to be incredibly tough. Let's get right into it.
So here's how we're going to break it down. First, we'll get into the good stuff, what the bulls love, exploring Hilton's flywheel effect. Then, we'll flip the coin and look at the risks. After that, we're going to follow the money to really understand its valuation, map out its road to future growth, and we'll wrap it all up with a simple checklist for any investor.
Okay, so let's just start with the one big question that really gets to the core of Hilton's entire strategy. You see this massive global footprint, right? We're talking almost 9,000 properties. But here's the kicker. Hilton doesn't actually own most of them. So how on earth is that possible?
Well, the answer is this pretty brilliant idea called the asset-light model. See, instead of sinking billions into buying and maintaining expensive buildings, Hilton basically acts as a brand manager and a service provider. It franchises its super powerful brand names, like Hampton Inn or the Waldorf Astoria, to other people who own the hotels. In return, Hilton just collects these really stable, high-margin fees. It gets all the brand power with none of the real estate headaches.
So what makes those brands so valuable that hotel owners are lining up to pay for them? It really comes down to this number right here. Over 226 million people are in its Hilton Honors loyalty program. Now, this isn't just some mailing list. This is the absolute engine of the company's competitive advantage. So let's connect the dots here and see how this massive loyalty program builds what investors love to call the flywheel effect. It's this powerful self-reinforcing cycle that's behind the entire bull case for the stock. It's this beautiful, virtuous cycle. It all kicks off with that huge loyalty program, which pulls guests in and gets them to book directly on Hilton's website. Now, that's absolutely crucial because it's way more profitable for hotel owners than paying big commissions to sites like Expedia. So, profitable owners are happy owners. And what do? They build more Hilton hotels. More hotels and more cool places attract even more members to the loyalty program, and that wheel just keeps spinning faster and faster.
And this isn't just some abstract theory, right? The result is something you can actually measure. On average, a Hilton property makes 14% more in revenue per available room, that's RevPAR, than its direct competitors. Now, if you're a developer deciding which flag to put on your new hotel, that 14% difference is an incredibly powerful reason to go with Hilton.
And that is exactly why Hilton's management can come out and tell Wall Street with confidence that they expect to grow their number of hotels by 6 to 7% for the next few years. That flywheel gives them a super clear, predictable path to growing their fees. It's the engine.
Okay, but it can't all be sunshine and roses, right? No investment is a sure thing. So now we have to be disciplined and look at the other side of the story, the case against Hilton and all the potential bumps in the road.
This slide really sums up the whole debate perfectly. You've got the bull case on one side, this powerful, resilient business model, that amazing flywheel, and best-in-class growth. But on the other side, the bears are pointing to some serious concerns. A tough economic environment, a stock price that's already pretty expensive, and signs that the whole post-pandemic travel boom is starting to run out of steam.
And we're not talking about hypotheticals here. These are real-world headwinds. You've got stubborn inflation that can squeeze people's travel budgets. High interest rates make it more expensive for developers to get loans to build new hotels. We're seeing the economy slow down in the US and China, Hilton's two biggest markets. And of course, there are the ongoing challenges of finding enough staff and the constant competition from disruptors like Airbnb. And this isn't just to worry about the future. We're already seeing hints of a slowdown in the numbers. Hilton just reported that its system-wide RevPAR actually dipped by 0.5%. Now, I know 0.5% doesn't sound like a lot, but in this business, it's a clear signal that the crazy revenge travel growth we saw is definitely starting to cool off.
All right, so we've got the bull case and the bear case laid out. Now, let's do what every good investor does. Let's follow the money. This part is all about the hard numbers, how the stock is valued, and how the company gives cash back to its owners, the shareholders. And this chart, this makes the valuation part of the bear case crystal clear, using a pretty standard metric that looks at a company's total value compared to its expected earnings. You can see Hilton trades at a big premium to its peers like Marriott and Hyatt. The market is pricing in some seriously high expectations here. It's basically saying, Hilton, we expect you to be way better than everyone else.
So why are investors willing to pay that premium? Well, a big part of it is the mix of hotels they have. Look at this. Hilton is heavily concentrated in what they call upper mid-scale and upscale. Think brands like Hampton Inn.
These are the workhorses of the hotel world. They tend to be incredibly resilient whether the economy is booming or busting, and that gives them a really stable base of demand.
And the other huge factor, it's just cash. So much cash. Because the business doesn't have to spend money on buildings, it generates a ton of free cash flow. And management's philosophy is simple: give it all back to the shareholders, mostly by buying back stock. We're talking $2.3 billion in 2023, and they're forecasting a whopping $3.3 billion for 2025. For shareholders, that's a massive driver of value.
So that brings us to the big question for the future, right? If things are cooling off a bit, where is Hilton's growth actually going to come from?
Well, the answer is right here. This number represents over 500,000 hotel rooms that are already in Hilton's development pipeline. These aren't just ideas on a napkin. These are hotels that are planned or under construction. This gives them just incredible visibility into their future growth, because every single one of those new rooms will add another stream of high-margin fees.
And Hilton isn't just sitting around waiting for those hotels to get built. They are playing offense, making really smart capital-light deals to expand. Just look at 2024. They partnered with small luxury hotels, they added the super trendy Graduate Hotels brand, and they bought the Nomad brand to get bigger in luxury. And notice the theme here. They're doing all of this without buying the actual buildings. It's brilliant.
Okay, so let's boil this all down. If you're an investor keeping an eye on Hilton, what are the absolute key things you need to be watching? Let's make a simple checklist.
It really comes down to these 4 questions. First, net unit growth, or NUG. Are they actually hitting that 6 to 7% target they promised? Second, pipeline conversion. Are the hotels in that huge pipeline actually opening on time? Third, relative RevPAR. Is Hilton still beating its competitors and keeping that 14% premium? And finally, and this one is so important, are the hotel owners still making good money? Their financial health is the fuel for all future growth.
So if there's one thing to remember from all of this, it's this. For the near future, Hilton's growth is all about adding new hotels to the system. It's not about being able to jack up prices at the existing ones. With RevPAR flatlining, the only way to grow earnings is to grow the number of properties.
And that really leaves us with the big central question for any potential investor. There's no doubt about it, Hilton has an incredible business model that's built for growth. But when you look at that premium stock price, you just have to ask yourself, is the market already pricing in a perfect, flawless future? That is the billion-dollar question.